Hi, I'm Angela Moore, Senior Retirement Editor at MarketWatch. Welcome to Financial Face-Off. We're going to take a look at some of the most common and debated financial questions facing us all. For each question, we've asked a MarketWatch journalist to take a side to explain the rationale for why each issue might make sense for you. They'll give you the arguments so you can decide for yourself. And in fact, during each face-off, we'll ask all of you to tell us which answer makes the most sense to you. To vote, simply use the camera on your mobile phone to scan the QR code that appears on your screen or go to slido.com. You can vote anytime during the face-off. So let's get started. In our first round, we'll tackle a perennial retirement savings question. What makes the most sense, a traditional or a Roth IRA? For traditional IRAs, we have Alessandra Melito, retirement writer for MarketWatch. For the Roth, we have MarketWatch columnist Brett Ahrens. Okay, we've got 8 minutes on the clock. Allie, Brett, we want a fair fight. Audience, remember to vote. At the bell, Allie, you begin.
Well, thank you so much for having me, Angela and Brett. It's always nice to chat with you. I will start by saying that traditional IRAs are very powerful tools, and they are particularly helpful if you expect to be in a lower tax bracket later on when you go to withdraw. So I will add that yes, what some might perceive as a downside with traditional IRAs is that you are paying a tax at the distribution, but that's not necessarily a bad thing when you have the power and the control to decide when exactly you take those distributions, because there's no it's not like the IRA company is telling you need it right now. So if you are looking at what income you are getting in retirement and you see that a lot of it is taxable, you can hold off on taking that IRA distribution. If you notice that a lot of your income in retirement is non-taxable, then you can decide to take a portion of your traditional IRA right then and there so that you remain in a lower tax bracket, but you are still taking some of your money out of a traditional IRA. So there is a lot of power associated with the traditional IRA, and I think it's very important to remember that.
All right, fair enough. Brett, what do you say?
Look, great. Thanks, Allie. I agree with so many of your points. I think, look, the most important single thing to remember here is that all IRAs, both traditional and Roth, are really powerful tools for saving for retirement. I'm a big fan of IRAs. Any IRA, in a sense, is better than no IRA. They're tax advantaged, and they're the sort of forced discipline of saving. That said, look, I know that traditional IRAs are more common. That's where you get a tax deduction when you contribute the money, but you pay taxes when you withdraw it in retirement. I want to make the case that more people ought to at least consider looking at a Roth, which works, as it were, in reverse. You contribute the money after tax, but when you're in retirement, there's no further taxes. And that's really one of the big advantages of a Roth, is that they're never taxed in the future. And there's a big issue here, which I think doesn't maybe get enough attention, which is that if you look at the national debt, if you look at rising debt and the federal government level, we're faced with the issue that taxes are likely to rise in the future. There's a very strong argument that taxes are going to rise in the future. And if so, anyone in a Roth is going to be protected against those rising taxes.
Those are great points. I agree with Brett that we will never know for sure what is going to happen as far as tax rates or just anything goes when it comes to Congress and decisions. But it also really does depend on when you plan to retire. So if you are retiring in the next few years, then you might be pretty safe right now as far as understanding or estimating what your tax liabilities will be. If you are retiring in maybe 10 years, there's a lot of uncertainty around what's going to happen. And if you're retiring in 30 years, there's even more uncertainty. We might see a tax hike and, in the span between 10 and 20 years, and then 25 years out, we might have somebody who decides they want to keep the tax rates low again. So I agree with that. Brett also did mention another point that I think is important for traditional IRAs, which is deductibility. There are rules around that as far as if you have an employer-sponsored retirement account, like a 401k, or what your income limits are. But tax deductions are a very, very, very beneficial tool, especially in the current year. So if you are contributing, say, the max of $6,000, you can see up to maybe $1,000 off on your tax bill. Of course, it depends on various circumstances like your tax bracket and all that. But who doesn't want to see at least some money coming out of their their bill to Uncle Sam? So I would just I would keep that in mind. This tax season is over, but next year will be here before you know it.
It's always coming back. That's one thing we can always count on. Brett, what do you say to that?
All right, look, here's a second argument for Roth IRAs. You are effectively saving more money. It is because you are saving, let's say you take the maximum $6,000. Because you are saving that net of tax, let's say you're in a 25% tax bracket, you've effectively had to save $8,000 because you've already saved the taxes on your retirement savings. So effectively, if you are able to maximize your your IRA allowance, if you're using a Roth, you're effectively saving more money. So it's a more disciplined, more forced savings.
I will add that depends on your tax bracket. Just like with traditional IRAs, it depends on your tax bracket at distribution if it is more beneficial to go traditional IRA or Roth IRA. But if you are going Roth, it's the opposite. You want to be in a lower tax bracket now than you would be at distribution. Otherwise, you could be paying more now. You know, say you're up at the peak of your earnings, you want to keep in mind what your tax bracket is now and what you can expect it to be in retirement. But that is a very good point, Brett. I will also do the opposite and say that traditional IRAs with that, because it is pre-tax money, it does feel like a little bit more bang for your buck at contribution. So, you know, that always feels nice.
Very true. Well, look,
Brett,
can I make one more point in favor of Roths? Something that I don't think gets enough attention, which is that because there are no required minimum distributions, Roths have fewer penalties in retirement and fewer hassles in retirement. I don't know who came up with these RMD rules, but essentially, if you are in a traditional IRA, you have to make sure that you take the required minimum distribution every year after a certain age. They've moved it from 70 to 72. They may move it to 75. You know, when I'm retired, I don't want to be dealing with rules like that. And the penalties for under-distributing are very onerous. I would much rather know that I don't have to worry about those once I'm in retirement.
It's a good point, Brett. Really good point.
All right, Brett, you got me there. Traditional IRAs do have required minimum distributions, but like you said, right now it's 72 and Congress is looking to upgrade it to 75 through the Secure Act 2.0, which is currently being discussed in Congress. And that being said, Roth IRAs are no less complicated. Unfortunately, both of these accounts, while very beneficial to your retirement savings, they come with plenty of rules. So with Roth accounts, you know, there is the age in which you have to be in order to take distributions, just like traditional IRAs. But then there's also the 5-year rule. And if you don't follow through with that, then you are paying tax and penalty on your distribution. So like your principal, for example, anything that you've contributed, you can take out, but you don't want to touch the earnings on that account unless you know that for sure that you have followed all of the rules associated. And, you know, that's something that you might want to talk to your investment firm about. And as far as distribution goes, there, both accounts do have the perks of qualified distribution. So things like death or disability or, you know, qualified education expenses. So it is important to know that, like Brett said earlier, both of these accounts can be great for your retirement savings, but
we're out of time. Sorry. You guys, excellent job. Excellent arguments. All right. Time is up. Let's see the results of the poll. Let's see. Whoa. Okay. Roth won. Sorry, Allie.
You got me, Brett. It's okay.
But as you both said in your excellent points, there's good sides and bad sides to both. And decisions like this are very personal. Don't count on us to make your decisions for you. We're just another brick in the wall of that. So don't crowdsource your retirement decisions. But Allie and Brett, you were amazing. Thank you so much for this. It was so helpful.
Great being here.
Thank you.
Okay, bye guys. Now we're on to round 2. In our second round, we're going to tackle another question that never seems to go away. What makes the most sense, buying or leasing a car? For buying a car, we have Sylvia Ascarelli, Deputy Commentary Editor at MarketWatch. For leasing, we have MarketWatch Editor-in-Chief, Mark DeCambray. Reminder, to vote, just use the camera on your mobile phone to scan the QR code that appears on your screen or go to slido.com. Okay, we've got 8 minutes on the clock. Sylvia, Mark, get ready. Audience, remember to vote. At the bell, Sylvia, you first. You begin.
Hi, Angela. Oh, I say buy the car, don't lease, because I'm all about getting freedom from car payments for at least some part of your life, even if you need a loan for that original purchase. Just imagine what you could do with the extra cash. But if you lease, you never get away from that yoke of a monthly payment, and you never have anything to keep after shelling out thousands and thousands of dollars for a car you don't even own. Mark, I know talking real numbers is no fun, but it's eye-opening. My example is the Toyota RAV4, the best-selling SUV in America. The average lease payment is $350 a month with $2,000 due at signing for a 36-month lease with 12,000 annual miles, or $428 a month if you're going to drive 15,000 miles a year. Same 2,000 down, according to TrueCar. So add it all up, that's $16,580 or $17,408 over 3 years, depending on your mileage option and before any other fees that get snuck in there. Depending on the trim, that's about half the cost of buying it new. But when you lease, sorry, you have nothing to show for that new car. So be smart, buy, don't lease, think beyond the monthly payment, drive the car for longer, minimize your long-term car costs.
Mark, what do you say to that?
Look, folks, don't be distracted by that long windup. Who buys a car anymore? The way I think of it is a bad car is like a bad date, and you really can't get out of that situation fast enough. So it's something to consider. And so it really makes sense to buy, rather to lease when you can get the coolest tech. All-wheel drive, a panoramic roof every 2 years. That's really the advantage of leasing. A car really is no small purchase, of course. But one of the things to consider is the average American spends about 8.5 hours a week in their car, Sylvia, based on a study commissioned by Cooper Tire in 2019. So, you can lease one that takes away some of that sting of throwing away all that money.
Mark, bad cars, bad dates, wow. Hopefully the bad dates of your past were one and done. And I would certainly hope that you do more research on a car than just swipe right. And also do more work than you put into finding that cool restaurant to impress the bad date. Basic stuff like reading Consumer Reports, Car Magazine, something like that. But to stick with your date idea, think of the test drive as just one date and you still haven't put any money down. So buy. But yes, Mark, if having the coolest tech is important to you, and so is getting that whiff of new car smell every 3 years, go ahead and lease. Just don't complain that you have that never-ending car payment, or two of them, because you're a two-car family, and then that you don't have enough money for something else you want. Again, I'm all about trying to get you not to have the perpetual burden of a payment and to be able to afford other things you want.
You make some good points, Sylvia, but listen, about 26% of new cars are leased rather than purchased, according to Experian. And as for mileage limits, the Transportation Department and the FHA say that the average person drove a little over 14,000 miles per year in 2019. So that's pre-COVID, pre-pandemic. That's well below that 15,000 mile on the higher end threshold that most leases offer. Listen, if you're the accident prone type, then leasing a car may not be for you. That's just the reality of it. But if you aren't, then you're looking at lower monthly payments on your lease vehicle compared with the monthly payment of a finance vehicle, including that hefty down payment you've got to come out of pocket. And as for dings and dents and what have you, many lease vehicles are covered under the warranty by the manufacturer for the entire duration of the lease. And under this coverage, the manufacturer or dealer may perform covered repairs. Of course, that's not going to include, damage due to some big accident or if you total the car. But your lease may also cover maintenance issues, which also include getting oil changes, though some may limit that. Those are all great perks, and you're not going to get that by buying a car.
I don't know about those perks, Mark. New cars come with the warranty too, the free oil changes, depending on your dealer. Certified pre-owned cars come with warranties too. So I don't see that as a big advantage for leasing. And yep, the payments on a lease are a bit lower than for buying, if assuming that you're financing the whole amount. But that's like saying interest-only mortgages are cheaper, so you should do that. And we all know how that ended in 2008. So something else to consider, the nasty surprises at the end of a lease period. So you tell me, what's normal versus excessive wear and tear with your kids in the car all the time? That ding or the scratch because someone in another car in the parking lot opened their door too wide and hit your car and you weren't there. So you couldn't even yell at them. The scrape to the front fender in a parking garage. Oh, and that was the valet. So too bad. Again, who decides what's normal and versus excessive? And guess who pays? You do. Overall, why play by someone else's rules? If it's your car, you decide if you can let the dings and dents go, how much you drive. You don't have to worry about those limits. And honestly, 100,000 miles on a car these days is hardly crazy. And you'd be free of a payment for several years if you went that route.
100,000 miles. Wow. I don't know where you're driving your cars to, Sylvia.
10 years of driving, Mark.
Listen, it's all about how you think about money is how I think about it. And a car is a depreciating asset at the end of the day. It's dead money either way. It's not as much as about, expenses as it is about selecting the best car option for your money. Because locking up your money on 4 tires is just kind of a bit of insanity. You buy a car, I don't really get it. You might be better off buying shares of Ford or Tesla rather than the stuff they, rather than, buying the actual car. I mean, you get more out of getting the stocks. And here's one thing to know. Leases typically include the option to purchase the car after the end of the lease. This is if your lease includes this option and if you find yourself attached to the vehicle after the end of your contract or the vehicle is worth more than the purchase option price. And buying the car may be a good option for you.
No, Mark, you're right. There is an option often to buy the car at the end of the lease. And you might be lucky right now because of the pandemic and the car shortage and the vehicle is worth more than the purchase price, the purchase option price. But don't expect that to be the case in 3 years when your next lease expires and we're back to normal in terms of no longer having a chip shortage. Just step back a bit, everybody. If you're focused on stretching out your dollar and getting as much car as you can afford, it may be time to rethink how much car you should be buying.
Okay, that's it. Enough said. Now, you guys did a great job. That's such a hot topic. Nice job, Sylvia. Nice job, Mark. Now, the audience poll. Let's see the results. Whoa, Sylvia, you got a lot of friends out there. You have the vast majority of the audience love. So, Mark, sorry, but them's the break sometimes.
I've been robbed.
Mark, we can meet again and talk about alternatives to buying a car.
You guys are terrific. Now, as I said before, these decisions are personal, so please don't put your financial decisions up for a vote. Do the research and make your own decision. But Sylvia, who got 76%, and Mark, thank you for this. Very helpful. So much good information. Take care, guys.
Thank you.
Okay, that was a spicy one. Now it's on to round 3. In our third round, we'll tackle one more tricky question, whether to use a health savings account with a high deductible insurance plan or skip the HSA and go with traditional lower deductible health insurance. For high deductible with HSA, we have Philip Van Doren, investment analyst for MarketWatch. For low deductible, we've got MarketWatch retirement columnist Robert Powell. Now remember, to vote, just use the camera on your mobile phone to scan the QR code that appears on your screen or go to slido.com. Okay, we've got 8 minutes on the clock. Phil, Bob, touch gloves, wait for the bell. Audience, remember to vote. Phil, you're going to begin.
Thanks, Angela, and hello, Robert. It's wonderful to be with you today. Each year, you might dread the open enrollment season for health insurance. And health insurance can be complicated and annoying, and many people take what is known as a low deductible plan, the one with the highest premium, because they want the best coverage. They want what we might all call a Cadillac plan. And each year we may blindly sign up for those plans again because open enrollment can be so annoying. But if you dig a little bit further into what is available at work, or even what is available if you buy your own health insurance, you might find that taking a high deductible plan, which means one with restrictions and lower premiums, might be right for you because it can go hand in hand with a health savings account. Now, there can be some confusion about health savings accounts. An HSA is different from a flexible spending account, which is funded with pre-tax money and has to be used each year or lost if you don't use it to cover medical expenses. The money in the HSA may never be taxed and will not be lost. It's there for you to spend on any medical related expenses. And if you don't use the money in the HSA, you don't lose it, and it can become another investment account, similar to an IRA or a 401k, and it can be invested in a manner similar to those accounts, and you may never pay taxes on it, and you don't have required minimum distributions as you do with IRAs.
So, Philip, it's great to be with you and have this debate. Let me first start by saying that there is a lot to like about HSAs, but let's take a step back. HSAs came into existence in 2003, and at the time were called IRAs for healthcare expenses in retirement. And truth be told, that promise has never really been realized. At the moment, the average balance in an individual account is $4,300. And in a family account, it's $7,500. Now, consider that Fidelity Investment estimates that a typical 65-year-old couple will need $300,000 set aside to pay for healthcare expenses in retirement. Those balances wouldn't even cover 1 year of healthcare expenses in retirement. And another reason to consider perhaps a traditional health insurance plan versus an HSA is that you may not have one at work. Just 1 in 4 workers have an HSA, and I'm sorry, just 1 in 5 workers have an HSA. That's about 63 million workers, and just 1 in 4 employers offer an HSA. And then the last thing I'll say is a personal story. 20 years ago, I had an HSA. I had 4 children. I would contribute the maximum to my HSA, and at the end of every year, there would be $0 left in my HSA. It never became an account for healthcare expenses in retirement.
Well, Bob is making some excellent arguments about how ineffective HSAs have been on a societal level. But he also mentioned that they are available at work for about 1/5 of U.S. workers. If an HSA and a low premium, high deductible plan is available to you, your employer may match your contributions. So if you don't anticipate high medical expenses, if you're the type of person who is detail oriented and wants to max out tax-deferred retirement savings and doesn't expect to go to the doctor very often, you might be leaving money on the table, a lot of money, if you don't opt for the HSA. So I agree with everything Bob said. Depending on your circumstances, the HSA may be a bad idea. The high deductible plan may not work for you, but then again, it might. So the devil is in the details. There are a number of questions you can ask yourself when considering whether or not to opt for a high deductible, low premium health insurance plan and a health savings account. So the first would be, how much would you save on premiums if you participated in the high deductible plan instead of the more expensive plan with the lower deductibles? Next question would be, would the savings from the lower premiums exceed the addition to the deductible. Another question would be, how much higher would your maximum potential out-of-pocket expense be under either plan? Finally, getting back to your personal circumstances, what type of medical expenses do you anticipate? One of the interesting things about family plans is that they may have similar premiums no matter how many children you have. So again, the devil is in the details. And I will add another advantage. If you pay for your own medical throughout your career and build up a large HSA, if you maintain your records of medical expenses, you can pay yourself back, so to speak, later in life and never pay taxes on that money. You can reimburse yourself for medical expenses several years ago, and that might be an advantage somewhere down the line. It's complicated, but it might work for you.
So, Philip, those are the right questions to ask, no doubt. And as we've heard in all these sessions so far, there are pros and cons to every financial decision, and every decision has to be based on your personal facts and circumstances. But what I've come to realize is that many financial advisors will tell you to use the HSA. They call it the Superman of retirement accounts. But they really often fail to describe the negatives. And let me just go through a quick laundry list. HSAs do require enrollment in a high deductible plan, as we've said. And according to the Kaiser Family Foundation, the average annual premium for those high deductible plans is $7,400 for a single person and $21,000 for a family coverage, and that the deductibles are $2,300 for a single coverage and $5,200 for family coverage. That's a lot of money. There's another behavioral thing to consider. There's often a lot of pressure to save money in your HSA and not seek medical care that you may need. So, and that's a big problem. 1 in 4 Americans don't seek out the medical care that they need. Another thing is that if you do use the money for non-qualified medical expenses before age 65, you'll pay ordinary income taxes plus a 20% penalty. And if you use the money for non-qualified expenses after 65, you'll pay an ordinary income tax on that. You mentioned a second ago that you can use it after age 65, but you have to keep your receipts. And if you're not good at keeping paperwork, an HSA may not be right for you. Another thing is that oftentimes these accounts are in low interest bearing accounts. Many people say you can invest in IRAs like mutual funds and ETFs and whatnot, but the truth of the matter is, more often than not, you'll be in a low interest bearing account. And then the biggest reason I think you have to think about is this. Illness can be unpredictable, and the costs associated with illnesses can be unpredictable. And so if you require a lot of medical coverage or you live in fear of the possibility of a healthcare shock happening, an HSA may not be right for you. I often like to think of it as an HSA is great if you're young, if you have a high income, but if you're in a family and perhaps in a lower income bracket, maybe an HSA may not be right for you. Maybe the consistency of a higher premium and lower unexpected costs may be right for you.
Well, there's no arguing with those points. The HSAs are not for everyone, but if you're detailed oriented and you're trying to max out tax deferred savings, they may work for you. Thanks, Bob.
Oh my gosh, perfect timing. No one's going to need the emergency room after that one. You guys made excellent points, the both of you, and nobody got hurt. So well done. Let's see. Okay, the results of the audience poll are Bob at 32% and Phil 68%. Wow, isn't that interesting?
I'm shocked.
So,
kudos to you, Philip. Well argued.
Thanks, Bob. Wonderful.
You guys, that was so interesting. And of course, particularly this, but all financial decisions are personal, and you need to do the research to figure out what's best for you. That concludes the Financial Face-Off. Congratulations to all of our winners, and thank you all who participated. Thank you again to our Financial Face-Off contestants and to all of our speakers today. And of course, thank you to everyone watching for spending your valuable time with us.